What does it mean that the loan is guaranteed by SBA? When a borrower comes and applies for a loan, first, the borrower is considered for a conventional commercial loan. That means 20% of the cash or any sort of injection will be brought into the deal. If it's 80% loan to value conventional loan, the borrower needs to have financial wherewithal, and we also assess the strength, the financial strength of the guarantors. But let's say there's a credit weakness in that loan. Let's say that the credit history for the company or the credit history for one of the guarantors is not the best. Or let's say there is insufficient collateral in that we are, let's say, doing a loan for $500,000, but we only have collateral worth $300,000 and we would be short to do a conventional loan. Or let's say that the company has only been in operations for 2 years and it's still considered fairly new or a startup, because we normally would like to see 3 years worth of financial history to assess the strength of the business. In that case, we would look into doing an SBA 7A loan. An SBA 7A loan has a 75% guarantee unless the loan is for $150,000 or less, in which case there is an 85% guarantee. And what does the guarantee mean? That really means nothing to the borrower per se, except that the borrower did not necessarily qualify for a conventional loan, and we are going to look into a different product. What it does to the lender, though, is where the difference is. SBA is a government agency that incentivizes financial institutions to do loans for small businesses to strengthen the economy and capitalism of the United States by saying, we would like you to do a loan for this borrower, even though there may be some sort of credit weakness. And what we would like to offer to you is a 75% guarantee. The 75% is not really a guarantee per se. There's nothing per se guaranteed in it. But what we are then provided as the lenders is a 75% loss sharing provision. That means if we do a loan for a pizza restaurant and we have used all the collateral we could, we did the loan, and heaven forbid, but the loan goes bad and we are facing with a loan default. What the lender will do is will liquidate all the collateral. So let's say the loan was collateralized with real estate and equipment and fixtures and inventory. We will sell all this at the highest price that we can obtain, and there may be a loss. We did a loan we discussed for $500,000 with, what did I say, 300 or 350,000 in collateral, let's say 300,000. We managed to sell it all for 200,000. So 500,000 of the loan amount minus 200,000 of the value of the collateral that we sold, we show a deficiency on the loan of 300,000. The bank has lost 300,000. But because we have 75% guarantee from SBA, SBA will give us a loss sharing provision where they will cover 75% of that loss, and the bank will only be exposed 25% as long as any and all documentation was in the loan file.